Okay, so with all the different possibilities, investing seems a bit of a gamble. Um, it can seem that way, and I suppose it's a couple of things with that. So, in the very short term, I would agree with you, really. Investing in the short term, we nobody really knows, as I kind of alluded to with our analogy of what might happen in 2024. It's difficult to tell what could happen in the very short term. And so what I would say is you have to kind of lengthen out, elongate your timescales. So if you look at a minimum of a 5 year period, actually the situation looks really different. So when you're investing, you're really looking at a minimum of a 5 year time horizon. So it's important to know that when you invest, you have to have at least five, if not 10 years, 20 years. The longer you go, the better. 10 years, you've never lost money, even after inflation, over a 10-year period if you invest properly over a decent amount of time. Um, and so it becomes less of a gamble if you think of a long-term picture. You know, if you invest over 5 years and you invest in a relatively adventurous portfolio that's invested in shares, funds, um, there's a pretty good opportunity that you're going to make money over the longer term. So, yes, in the short term, it's a bit of a gamble, but you don't invest over the short term, you invest over the long term. Also, I would invest in quality. So when I say quality, I mean that you invest in companies, portfolio managers that have got a long track record, a large, have got a big team of people. You don't want to be looking at the next big thing or what you've heard or what your mate down the pub's recommended or what you've read in the newspaper. We spend a lot of time and energy and money really researching and monitoring our portfolio managers to ensure that they're doing their job and they're performing in line with what we expect them to do. So you want companies with a long track record. You don't want companies that have just sprung up or looking for the next returns that just don't seem feasible. So that's definitely something to watch out for. And another thing would be, so we've got costs, sorry, not costs, we've got, well, cost as well. Cost is important. We use a kind of a blend of tracker and active management. So our portfolios use trackers where we feel that active managers can't really provide any value. So it tends to be the developed markets, but we use active managers where there's less research, where there's more opportunities. So it's a blend really between cost and performance. Um, and it's important really that you are really well diversified as well. So as I alluded to in the initial chat, different parts of the world might react differently to different medicine. You know, like America did superbly well last year. We don't know whether they're going to do really well this year. China and emerging markets did poorly this last year. Perhaps they're going to recover this year. UK, same. So um, it's difficult to tell what could happen depending on events around the world. So this is why you're really well diversified, both geographically, both investing in funds. So each individual, so to give you an example, our portfolios have 30 to 35 funds within the portfolio, and each fund has 80 to 100 shares in it. So you're really well diversified, both geographically and spread across different regions and different types of companies, smaller companies, larger companies. And then for those that don't want to take the full investment risk of investing in share funds, you invest in different asset classes like bonds and cash savings accounts, gilts, property, different asset classes that can act as a buffer to the short-term volatility of the stock market if you feel that's more comfortable for you. So um, that's quite a long answer to that question, but it can be a gamble, but not if you take advice and have a kind of a longer term view on it, really. I hope that's answered that.